Hi guys, this video is a continuation of the chapter 19 videos on balance day adjustments on revenues. And this particular one is all about how we record unearned sales revenue, but where a deposit is paid. If you have not watched the unearned revenues video on chapter 19, I highly recommend you do because there will be some assumed knowledge in this one. What are the learning intentions from this video? I hope by the end of this video that you understand how to prepare the balance day adjustment for unearned sales revenue where a deposit is paid, and you can prepare the adjusting entries in the general journal and then record this in our general ledgers. So before we go through this, let's just make sure that we're really clear on what a balance day adjustment is. It's on the balance day, so the day we're going to make reports. We look at all our information that we know about our business and consider, do we need to adjust this information, these numbers, to accurately reflect what's happened in the business. So faithfully represent what happened in the business. And we need to follow the accrual basis assumption. We need to look at all of our activities and make sure that everything that in our reports shows what revenue was earned and expenses incurred. These set of videos focuses on making sure that the revenue earned is recorded in our reports. Unearned revenue and deposits looks at this particular issue. Sometimes a customer orders goods from a retailer and pays a deposit in advance. And you might have even done it yourself. You pay the deposit in advance before receiving the goods. This often occurs when a new product is really popular, i.e. a new video game or a car, and hence the customer pays in advance. It also might occur if someone is getting something made that is going to be customized. So the manufacturer, the person making the product, wants to make sure a deposit is paid because it's going to be really hard to sell that custom product to anyone else. So they typically get a deposit to cover the materials that are going to be used into that product. When a sale is completed afterwards and inventory is provided, we also need to make entries to record the revenue earned and reduction in liability. I'll explain why it's a liability in a second, but also the stock leaving the business. What does that mean? Essentially, we need to record the actual sale. So if we look at the example in the top right, this is the example that we're going to look at for the entire of this video. A customer has ordered 30 coffee tables for their motel business, and their motel business is Money Valley Motel. The coffee tables are sold for $500 each plus GST, and the cost price of a table is $250. So this is what we're going to look at for the entirety of today. But let's just take a step back. Unearned revenue, we can only record revenue when it is earned. So if we get money, maybe like a deposit in this case, it's going to be recorded as unearned revenue and a liability beforehand. What do we need to understand about a deposit? A deposit does not include GST. So anytime you see the word deposit and a certain money, doesn't include GST, but it does represent unearned revenue as we've received something in advance and the goods have not been delivered. So in this case, the example that we just talked about, we are now going to look at the process of recording a deposit and the sale, because the following two events have been recorded. On June 1, the business, Money Valley Motel, paid a deposit of $100 per table. So $3,000 was banked, and we know it was banked because we've got a receipt. On June 28, the business made the coffee tables and delivered them, and the invoice was issued. Invoice being issued means, what do we know has happened here? It is a credit transaction. The business, Money Valley Motel, now needs to pay us back, but haven't paid us back yet. So how should the deposit be treated in the books of the business? Have a think. So first, we must record the deposit in our general journal. We've received $3,000 of cash. So instantly, I hope you're thinking that $3,000 of cash means the first thing we're going to record in our journal, we're going to go from top to bottom, debits to credits, Cash at bank has gone up by $3,000. Assets going up are debits. The credit here is going to be unearned sales revenue. This is your general ledger name. It is sales revenue that has been unearned. We can't call this revenue yet. We haven't earned it because we haven't given the coffee tables yet. We don't have revenue, we have a liability going up. And the liability going up is unearned sales revenue, liabilities going up are credits. So we think of what's happened to our elements. We have an asset going up and a liability going up. We have not made any profit yet, and we have not increased our owner's equity. Because assets up, liabilities up mean it balances. No GST because we know there is no GST in deposits. As we said, GST is not received when a customer makes a deposit. The deposit is simply made to secure the order. So what happens when we actually complete the sale? When we actually, on June 28, deliver 30 coffee tables that we're selling for $500 each and cost us $250. We have to record the sale as if it would normally occur, but the numbers are going to look a bit funny because there's already a deposit. So hopefully you remember when we make a sale, there are 5 debits and credits to make. And here are the 5. Firstly, we have accounts receivable. We know it's accounts receivable because it says invoice. The customer still owes us money, but it's an asset. If it said receipt here, it would be cash at bank. Our accounts receivable is an asset that has gone up, being a debit, and it's $13,500. And you might stop for a second and go, hang on, I've times 500 by 30, and I know that that equals 15,000. 15,000 plus GST of 1,500. Surely the business now owes us 16,500. Hopefully you're remembering there was a deposit already paid of 3,000, so they've already paid part of it. So surely they don't need to pay that deposit again. So 16,500 minus 3,000 equals the amount that they need to pay us now. This can be split up between GST clearing, the GST clearing that we've received that we must pay to the government. Liability going up is a credit. And it is $1,500 because remember there was no GST on the deposit transaction, so it's all contained in this. Sales revenue, we've now earned it because we've given the tables to the Money Valley Motel. This is $1,200 to make sure our debits equal our credits. And again, you might be going, hang on, I've sold 30 coffee tables for $500. Surely my revenue is $1,500. Remember, our debits must equal credits, and there is another step to go. Again, we must record our inventory leaving our business. 250 times 30 is 7,500, and our cost of sales is 7,500. So that's how you record it, and it's probably looking wrong. This doesn't seem to match up. I know that my cost price is only half of my sales price. My markup is 100%. These numbers just aren't looking right. They don't look right because now we have to do our balance day adjustment. We have to adjust for the unearned revenue deposit that we recorded. Remember, we recorded a deposit on 1st of June of $3,000 where cash at bank went up, debit, and we recorded a liability of $3,000 of unearned sales revenue. To reverse this, because we now no longer have a liability, we've done what we needed to do, we've met our obligation, we're going to reduce that liability of unearned sales revenue. Liability will go down to nothing, liabilities going down are debits. And this is where the extra $3,000 of sales revenue that we were missing, that was making the numbers look unusual previously, we're going to turn that liability into revenue, hence the $3,000. A narration of adjusting entry for revenue now earned. And this is where it starts to look a bit different, but that's how we do it. In summary, the deposit can now be recognized as revenue earned as the goods have now been delivered. We've done the invoice, we've done what we need to do. Our obligation of a liability no longer exists. So how does it look? How can we be sure we've done it correct given the numbers looked a bit different? Let's reconcile the sales account, which we know must equal 15,000 because we sold 30 coffee tables for $500. If we think it through what our debits and credits have, we have recorded two actual credits if we look at our general journals. $12,000 as our accounts receivable, and I'll go back to that one. You can see the $12,000 here as sales revenue, and also $3,000 as a credit here. So if we add those up and make the correct cross references, and it's a little bit of an error here, it should say unearned sales revenue here. Again, apologies. We've recorded our correct 15,000. The reconciliation of our accounts receivable, we know that we should only expect 13,500 from our customer. Yes, they owe 15,000 plus GST, 16,500, but they've paid the deposit. So the final balance of the accounts receivable should be 13,500. And if you look at what we've recorded in our ledgers, that adds up as well. So that's how we do unearned sales revenue with a deposit. There is a balance day adjustment and a few other steps along the way. This might be one that I recommend that you get a bit of a loose leaf bit of paper just before you do it and work out the ins, flows, outflows before you jump to debits and credits, because sometimes the things will look a little bit funky there. It really is one that you will commonly see on an exam and one that you really must practice. Now's the time to practice this new balance day adjustment, unearned revenue with deposit.